Question 846. A contract breach will excuse the wronged party's duty to perform under the contract depending on whether or not the breach is A. Minor or material, B. Compensatory or punitive, C. Practical or theoretical, D. Monetary or non-monetary. Correct answer is A. Minor or material. Compensatory or punitive refer to types of damages awarded for a breach, not the nature of the breach itself that would excuse performance. Practical or theoretical are not legal classifications terms of contract breaches. While a breach can involve money or not, this distinction doesn't determine whether the wronged party is excused from performance. A non-monetary breach can still be material, e.g., failing to deliver a unique item as promised. A material breach of contract is a significant violation of the contract's terms that substantially impairs the contract's purpose. When a material breach occurs, the non-breaching party is generally excused from performing their obligations under the contract and may seek damages. A minor breach is a less significant violation of the contract that does not substantially impair the contract's purpose. In most cases, a minor breach does not excuse the non-breaching party from performing their obligations, but they may be entitled to damages to compensate for the breach. Therefore, the severity of the breach, whether it's minor or material, determines whether the non-breaching party is excused from performing their obligations. Question 847. The market data approach in appraisal is based on the principle of A. Substitution, B. Conformity, C. Socialization, D. Anticipation. Correct answer is A. Substitution. Principle of socialization is not a recognized principle of real estate appraisal. The principle of conformity states that maximum value is realized when a property is in harmony with its surroundings. Example similar in style, size, and quality to other homes in the neighborhood. While important in appraisal, it's not the basis of comparing sales in the market data approach. The principle of anticipation states that value is created by the expectation of future benefits to be derived from the property. Example future income, appreciation, amenities. This principle is more directly related to the income approach to appraisal, though it influences all value decisions. Principle of substitution states that a prudent buyer will pay no more for a property than the cost of acquiring an equally desirable substitute property that is available without undue delay. In the market data approach, an appraiser looks at comparable properties that have recently sold. The assumption is that buyers in the market would substitute the subject property for a similar one if it offered comparable benefits at a lower or equivalent price. Therefore, the value of the subject property is substituted by the values of comparable sales. Question 848. Principal Pat asked broker Bill to advertise, show, and then sell Pat's home to buyer Ben. After the purchase agreement was signed, Pat tried to rescind it by saying that their listing agreement had expired. When Ben is able to prove that Pat was aware the term had expired and chose to let broker Bill show the house anyway, Pat will be compelled to abide by the purchase agreement due to the doctrine of A. Estoppel, B. Ratification, C. Unlawful detainer, D. Implication. Correct answer is A. Estoppel. Agency by estoppel applies when a principal, Pat, creates an appearance of agency, leading a third party, buyer Ben, to reasonably believe that an agent, broker Bill, has authority. Because Ben relied on Pat's actions, allowing Bill to continue showing the house despite the expired agreement. Pat is estopped, or prevented from denying that Bill had the authority to act as his agent, thus protecting Ben's interest. Pat's actions created the appearance of ongoing authority, and Ben relied on that appearance to his detriment, entering the purchase agreement. While Pat did effectively approve Bill's actions by letting him continue, the core of the compulsion here from Ben's perspective is that Pat led Ben to believe Bill still had authority. The emphasis of estoppel is on protecting the innocent third party who relied on the principal's conduct. In summary, Estoppel focuses on the principal's conduct that misleads a third party into believing an agent has authority, thus binding the principal to protect that third party's reliance. Implication focuses on the agent's actions that create an agency relationship by conduct, protecting the principal, though it can also bind the principal. Ratification focuses on the principal's after-the-fact approval of an agent's unauthorized act. Since Ben can prove Pat knowingly allowed Bill to continue showing the house, Pat created an appearance of ongoing authority. This action led Ben to reasonably believe Bill was authorized to act as Pat's agent. Therefore, the doctrine of estoppel compels Pat to uphold the agreement to protect Ben's reliance on that apparent authority. Question 849. During the subprime loan era, arranging low payments in the beginning of the loan term enabled borrowers to purchase more expensive properties than they could actually afford. When the interest-only period of the loan ended and large amortized payments were required, the borrowers experienced A. Capitalization, B. PMI, C. Payment shock, D. Points payment overload. Correct answer is C. Payment shock. Capitalization is a financial accounting method used to allocate the cost of a long-term asset over its useful life. It's not directly related to the issue of payment shock. PMI, private mortgage insurance, is insurance that protects lenders from losses in the event of a borrower defaulting on their mortgage. While PMI can increase monthly payments, it's not the primary cause of payment shock in the scenario described. Points payment overload refers to a situation where a borrower pays too many upfront points to reduce their interest rate. While paying points can increase the upfront costs of a loan, it doesn't directly cause payment shock. Payment shock occurs when a borrower experiences a sudden and significant increase in their monthly mortgage payment. This often happens with adjustable-rate mortgages, ARMs, or interest-only loans, where the initial payments are low but then increase significantly later in the loan term. In the case of subprime loans with low initial payments, borrowers might have been able to qualify for larger loans than they could truly afford. When the interest-only period ended and the principal payments began, the monthly payments increased dramatically, leading to payment shock. This often resulted in borrowers struggling to make their payments, leading to defaults and foreclosures. Question 850. Most lending contracts have a right of rescission, which provides the borrower with the opportunity to cancel the loan without penalty if the right is exercised. A. Within 1 day after the loan agreement is made. B. Within 3 days after the loan agreement is made. C. Within a week after the loan agreement is recorded at the county recording office. D. There is no right of rescission available to cancel a loan. Correct answer is B. Within 3 days after the loan agreement is made. This right of rescission is mandated by the Truth in Lending Act, TILA. Specifically under Regulation Z, for certain types of consumer credit transactions secured by a borrower's principal dwelling. It applies to specific loans, most commonly refinances of a primary residence, home equity loans, and home equity lines of credit, HELOCs. Please note that this right does not apply to all types of loans. It generally does not apply to purchase money mortgages, loans used to buy a home, or to loans for secondary homes or investment properties. The 3 business days begin after the latest of 3 events: the signing of the loan agreement, delivery of the truth in lending disclosure, or delivery of the notice of the right to rescind. During this 3-day cooling off period, the borrower can cancel the loan for any reason without penalty. Question 851. Listing agreements can be recorded with a title company if A. Both parties agree. B. The broker has a signed agreement with the title company. C. The owner fails to file a written objection within 30 days of signing the listing agreement. D. Listing agreements are not recorded. Correct answer is D. Listing agreements are not recorded. The primary purpose of recording documents with the county recorder's office is to provide constructive notice to the public of interests in real property. This includes deeds, transfers of ownership, mortgages, deeds of trust, liens, easements, and other encumbrances that directly affect the title or possession of the property. Recording protects innocent third parties by making these interests public. A listing agreement is a contract for services between a property owner and a real estate broker. It grants the broker the authority to market and sell the property and establishes their right to a commission. It does not directly transfer ownership, create a lien, or establish an interest in the property's title that requires public notice in the same way deed or mortgage does. In California, recent legislation, Assembly Bill 1345, effective January 1, 2024, specifically prohibits the recording of exclusive listing agreements for residential real estate. This prohibition was enacted to curb predatory practices where certain companies would record long-term listing agreements, essentially placing a lien on a homeowner's title. Such actions trapped owners, making it difficult to sell or refinance their property without paying excessive fees. Such actions trapped owners, making it difficult to sell or refinance their property without paying excessive fees. The new rule ensures these agreements can't be used to encumber a home's title. This legislation further solidifies the principle that listing agreements are not instruments that should be recorded. Therefore, listing agreements are generally not recordable instruments because they do not convey or encumber title to real property in the way that other recorded documents do. Question 852. A listing broker asks another broker to assist him in procuring a buyer for the listed property, and they make an oral agreement to work together. This other broker, called the cooperating broker, succeeds in finding a ready, willing and able buyer to make the purchase. However, the listing broker refuses to share his commission payment with the cooperating broker. The cooperating broker A may not recover his commission split because the agreement with the listing broker was not in writing. B may recover his commission split by pursuing the matter in a legal proceeding. C should ask the owner to pay him his share of the commission. D may not recover his commission split because only one broker can be paid per property transaction. Correct answer is B may recover his commission split by pursuing the matter in a legal proceeding. While a written agreement is ideal, it's not always required. In many cases, oral agreements between brokers to cooperate on a real estate transaction are enforceable. If a cooperating broker can prove an oral agreement and that they produced a ready, willing, and able buyer, they can likely recover their commission share. They may pursue legal action to enforce this valid claim against the listing broker. The key factor is whether there was a clear understanding between the two brokers about the commission split. If the cooperating broker can provide evidence of this agreement, they may have a strong case for recovering their commission. The cooperating broker cannot directly ask the buyer to pay their share of the commission. The commission is typically paid by the listing broker. It's common for multiple brokers to be involved in a real estate transaction, and they can all be entitled to a share of the commission, as long as there is a clear agreement in place. Question 853. A real estate agent tries to persuade a group of people in a neighborhood to list their property for sale with the agent because members of a minority ethnic group are planning to move in, which the agent warns will lower overall property prices in the community. The agent's conduct can be termed all of the following, except A. Blockbusting, B. Panic selling, C. Against the regulations of the real estate commissioner, D. Illegal, but not against the regulations of the real estate commissioner. Correct answer is D. Illegal, but not against the regulations of the real estate commissioner. Blockbusting is a discriminatory and illegal practice in real estate. Agents induce homeowners to sell their properties by creating fear that the entry of a particular racial or ethnic group into the neighborhood will cause property values to decline. This exactly matches the agent's actions described. Panic selling is the direct result that blockbusting aims to achieve. The agent is trying to create panic among the homeowners to make them sell their properties quickly and often at a lower price. Blockbusting is explicitly prohibited by federal fair housing laws, like the Fair Housing Act of 1968, and by state real estate licensing laws and regulations, including those enforced by the Real Estate Commissioner in California, DRE. Engaging in such behavior would lead to severe disciplinary action, including license suspension or revocation. Therefore, blockbusting is illegal under federal and state law, and state real estate commissions are responsible for enforcing those laws among their licensees. It is absolutely against the regulations of the Real Estate Commissioner. Their regulations specifically prohibit discriminatory practices like blockbusting. Question 854. Someone who is designated to carry out a specific transaction is called a secret agent, b. general agent, c. special agent, d. transactional agent. Correct answer is C. Special agent. Secret agent usually refers to a spy or an undercover operative, not a legal agency relationship. A general agent is authorized to conduct a series of transactions or a wide range of business activities on behalf of the principal. Their authority is continuous and extends to all matters connected with a particular trade or business. A property manager, for example, might be a general agent for an owner. While some states recognize transactional brokers, or transaction brokers, this is a specific role in real estate, where the broker facilitates a transaction without representing either party as a fiduciary. It describes a type of agency relationship, or lack thereof, not the general legal term for someone designated for a specific transaction. The broader legal term for someone designated for a specific transaction is a special agent. A special agent, or specific agent, is authorized by a principal to perform a particular act or transaction. Their authority is limited to that specific task, and they do not have ongoing authority to bind the principal in other matters. In real estate, a real estate broker acting under a listing agreement to sell a specific property is typically a special agent. Question 855. The concept of present worth of future benefits relates to a. market value, b. income, c. rental properties only, d. commercial property only. Correct answer is b. income. The concept of present worth of future benefits is most directly and explicitly applied in real estate appraisal when determining the value of income-generating properties. Income approach to appraisal approach directly estimates the value of an income-producing property by converting its anticipated future income streams into a single present value. This process is called capitalization. For properties like apartments, office buildings, or retail spaces, the future benefits that a buyer anticipates are primarily the net income those properties will generate over time. The capitalization process takes that expected future income and discounts it to its current equivalent value, which is the present worth. The concept of present worth of future benefits broadly applies to all properties, as even a home offers the future benefit of shelter. However, its most direct and mathematically explicit application in real estate appraisal involves the capitalization of income. This technique converts anticipated future income streams into a single present value, primarily for income-generating properties. Therefore, income is the most accurate and specific answer as it directly ties to the primary method where future benefits, in the form of income, are converted to a present value.